the 30th. I recommend that you all stop by, talk to the pro sales people. They give away a ton of stuff I've seen over the years. Depending on which store, they have a variety of things from different vendors. But good to know these people and sign up. You can win some free stuff, which is never a bad thing, and get to know the people there that will certainly help you with your savings. The big thing for us, Glidden PPG, is that entire week you normally get your 20% off every year throughout the year with the Glidden PPG paints, but that week you get 25% off the Glidden premium line, interior and exterior. Hopefully the weather will be decent, so we have some exterior paints use, but that is a great week to save an extra 5% on that specific line of paint. The only other thing I do have to say is, as far as raw material costs, I don't have anything specific, but everything I've been hearing, the costs are certainly not going down. If anything, they've risen a little more. We are not doing a price increase until next year, as the other vendors typically do. However, come next spring, I expect a decent price raise. So to offset that, we are offering pallet pricing incentives. The pricing, I should say, will stay the same at your 20% off. However, we're adding another 20 gallons to any order that you place of 80 gallons or more. We offer an additional 20 gallons free of charge, and we, as always, will deliver it directly to your job site. And that does run from now through the end of the year. That's everything I have. Thank you for your time, and I hope everybody enjoys this evening.
Thanks, Jamie. Appreciate you. All right, Leon. Oh, actually, we're going to get our other vendor that's in the room to come up and give his 5-minute shtick. So the microphone's here. Just speak up so it'll pick you up. It should be fine. You don't need to hold it. Okay. It'll be okay at the desktop.
I was here last meeting. There's a lot more people here. I don't know if they heard I was going to speak again, and that's why they stayed away. But actually, I'm not speaking. You have a great real estate CPA, Chris Sardone, speaking later. I just wanted to introduce my firm. We're one of the sponsors here, JM Real Estate Capital. And we have a lot of capital to lend for all manner of real estate transactions. We do business in all 50 states. We basically are involved in everything: refis, cash outs, rehab loans, more and more commonly new ground construction. And we do a lot of rental lending. We feature high LTVs, although they're not as high as they were, because a lot of the underwriters are getting nervous. And we have very aggressive and competitive rates. As you heard from the prior speaker at Home Depot, prices are not coming down. That's translating into the financial market. We have interest rates going up. I spoke last time, and I've been speaking for 6 months about getting into this business in 1981 as a kid at a newlywed. And I at 19% interest rates, and I saw the bottom a couple of years ago at 2.5% as an old man and a grandfather. So I've seen the whole cycle, and I've seen the cycle turn. The only good news is that the financial system is under a great amount of stress now. There's a lot of panic with the Fed and a lot of different central banks around the world. So I think you're going to get some sort of a break, some sort of a pullback where the rates might come in. I think that's an opportunity, but I think it's an opportunity that you have to take advantage of, because I think the cycle for rates is clearly higher now. If we get a little softness in the economy, if the Fed panics a little bit and backs off, then rates will come in, and I think you're going to get a window of opportunity in the market that I would take advantage of. We can do a lot of transactions that the banks won't touch. Vacation properties, commercial properties with a 30-year fixed rate on a commercial property, and we're very competitive. If you have a deal that's hard to get done, the banks don't want to look at, give us a call. We may not be able to help you, but if it's doable, we usually can get it done. Thanks for your time. Anybody would like a card or For sure.
Thank you very much. And with that, now we'll let Leon do the rest of the intro. I don't know what announcements he might have, but I'm gonna mic out here.
Can the JM Capital put their name on the internet, on the Zoom? The phone number, please.
Yep, we'll get that done for you. I'll put it in the chat.
Thank you. Also, Mr. Francis, Jimmy Francis also.
Yep,
Thank
no
you.
problem. We'll get that up there for you.
Can't hear.
Yeah, I'm not hearing.
I can just use a big mic.
Oh, I can hear.
Okay, can you hear me now?
Yes.
Yep.
All right, super. I was just saying, for the folks who don't know me, my name is Leon Griggs. Most of the people in the room know me, of course. And I just wanted to welcome everyone for being here tonight. I need to speak a little louder, you're saying? All right. So not going to take up a lot of time. Just want to make sure that go over a couple of things. Tonight we're having a great speaker. Next month, and I'll get into the great speaker part a little bit later, a couple of minutes from now. But the key thing is next meeting is in November. It's going to be a meeting where we're going to have vendor night. So what we're going to do is set up this room, and we'll have some tables for some of the vendors. We'll have some vendors who won't have a table that just want to speak and tell you about what it is that they do. So that's going to be the meeting coming up in November. Okay, and of course in December, that's when we have the holiday party. So I know we'll see everybody there at the holiday party. Tonight you have a special guest. I've known him for many years. He and I always debate back and forth about how long it's been. I like to make the time period a little bit shorter than he does. And I'm talking about Chris Sardone, who happens to be my own personal CPA. And he's also the CPA that a lot of people in this room use. And we do that because one, he understands real estate investing. And I did say he was a CPA. He's bought properties and sold properties before, and he understands exactly what it is that needs to be done to take care of your taxes in all the directions that you should be taking as a real estate investor. So he's got some handouts. He's got some things that he's going to go over. He and I had a little brief talk, and he said, there's so many things out there, we can talk for hours. And I said, well, no, we only need about 30 minutes, you know? So with that said, without further ado, we're gonna get into the presentation from Chris Sardone. As I said, one of the people that I've known for quite a while. Chris?
I think I have an advocacy update before he jumps on here. Sweet, you want me to use a little table mic?
Okay.
Actually, it's easier to just, yes, please swipe this.
Hello, my name is Jake. I serve on the legislative committee for the NAA chapter in upstate New York. We are drafting a bill for 2023 legislative session. So instead of being on the defense, we're going to be on the offense. That's a big deal for us. We've always been reacting to the radical legislation from the state. Now we're going after it in the offensive. So as an assurance to you that your donations to REIA, donations to Under One Roof, now apartments in New York are doing work in the back end. So as there are updates, they will come through the FREIA mailing list, and they will come through various Rochester Housing Coalition emails. Locally, we're fighting against Airbnb restrictions in Rochester and other such zoning things that are coming up. So if you're interested in what's going on locally or statewide with housing politics and housing policy, I'm probably the guy you should approach and ask questions of. That's all I got. Thanks so much.
Chris, I'm getting out of your way. You're all good.
Is this on? Testing? Good.
Testing, testing. Can everybody hear Chris online? Think we're
Can you
good?
hear me okay?
Yes, no, maybe so. Jack, are you there?
Jack,
Yeah,
can you hear me?
yes.
Okay, that's good.
All right.
Usually there's not a problem with people hearing me, but if I'm not loud enough, let me know. So, good news. Maybe good news. So if you strip out what's causing increases in inflation, and you leave only housing, food, and gas, we're at like 24%. And I'm sure you realize it. So I hope you're not buying the crap that it's 8.7. Because it's 8.7 when you include Hasbro toys and maybe gumballs out of a gumball machine. But when you look at the things that senior citizens spend their money on, we're at 24%. So I don't know if it's bad news or good news, but Social Security is doing the largest increase in over 40 years, 8.7%. We're supposed to be happy about that. So if you get $1,500 a month, you're going to get like $122, but your cost of living probably went up $225. So somehow you're supposed to be happy and vote everybody back in office. Okay. I'm going to try not to be political, but I will. So I sort of apologize that I don't mean to offend anybody, but just so you know where I'm coming from. I do have guns. Okay. I do believe in religious freedom. I'm just in a different world. Okay. I don't know. I don't carry a gun though, because Hogle said we can't carry guns. We can get gun permits, but we can't carry the guns because it would make it too difficult for people to rob and shoot people if other people had guns to protect themselves. So if somebody comes in here with a gun, I'm getting the hell out because I can't carry my gun. Just so you know, don't look at me and say, I know Chris carries a gun. It's not happening. I'll go right out the window if I have to. So I'm just being upfront with you, okay? Because I don't like breaking laws. Okay, now let's talk about. I'm going to talk about the topics that people call me on the telephone all the time on. Okay, so they're common things. Some of you may have questions about real particular stuff that will affect you and nobody else. You got to call me for that. I got cards on the desk. I prefer you email me, because if you email me, then I can get somebody else in my office who knows the law better than that to answer it. But our response, it looks like I know all this knowledge. So email is better. Okay. But I want to go over a few topics with you. First of all, let's talk about what's happening with depreciation. Bonus depreciation, Section 179 is still around. As it relates to real estate investors, most of you probably know this, but I'm just going to read it. Qualified improvement property can be written off all in 1 year as bonus or Section 179. And because we're in New York State, there's a plus and minus which one you use, but they both allow the write-off. But what is it? Well, the original law said improvements to a building's interior. However, improvements can also be roofs, HVAC, fire protection, alarm system, and security systems. The big one being roofs and HVACs. You can put in a new roof, a new HVAC on an existing building that you own, and you could take that all in 1 year. Okay, if it makes sense. You know, everybody always likes deductions, but you got to look at it. Those of you who do primarily flipping, it may or may not make sense. You have to really look at it because you don't want to be taking deductions and wiping out a 15% tax bracket, and a year later find yourself in a 38% tax bracket with those deductions gone. So it's just not automatic. But the important thing is it's alive. It stayed in the law, except there's a little phase out, which they're phasing it out. So starting in 2023, you're only going to get 80%. And then it's going to go to 60, and then it's going to go to 40. Now, why is it phasing out? Because when they pass these laws, this is the new thing they do in Congress. They do sunset provisions. So when under Trump, they did the 15 years, the leasehold improvements, which includes interior, roofs, HVAC, it was set up to expire at the end of his term. The thought being, the Democrats thought, well, we'll be back in control and then we can screw people on taxes, which we typically like to do. Well, what ended up happening is they were pushing to get a bill through and they ended up leaving it in. So they reenacted it to continue it, but with a 20% per year phase out. Okay, so you got to kind of watch that. I mean, I have in my own mind ways to get around it, but I don't usually lecture about gray areas. But I think that most CPAs probably have ideas on how to get around at least the first couple of years in the early stages of the phase out. But it's going to go from 80 in 2023 to no bonus depreciation in 2027. So they are phasing it out, but keep in mind, there's a presidential election coming up in 2 years. So usually whoever is in office always has to have their tax bill. It's kind of an important thing when you're president, is that you have security, you get free drinks, and you have a tax bill. It's kind of a requirement. So I think there's a good chance that we'll be seeing a tax bill that may modify that. You know, we can only hope. And I want to talk a little bit about cost segregation. Here's what I find in my practice. The people who know about cost segregation and do it are the very people that shouldn't be doing it. And the people that should be doing it aren't doing it. Okay? So if you're buying a house that you're going to flip in a year or two, you don't need to be hiring an engineer to do a cost segregation study. You're not going to hold it long enough, you know, and it's going to go. It's not a big deal. If you're only spending $50,000, $60,000, you don't spend the money on a cost segregation report. But if you go buy an apartment building, if you buy storage units, and you're spending big money, you're buying a 5-family on Park Avenue, that's when you should be getting an engineer to do a cost segregation. Now, what cost segregation is when they take the building you bought. So it's when you're buying the building. They take the building when you buy it and they break it down into all of its components. So you're buying something for $120,000, let's say. Usually we'll say 10 for land. I know we know the land's worth 70, but we'll say 10 and 110 for the building so we can depreciate the building over 27 and a half years if it's residential, 39 if it's commercial. Cost segregation will come in and they'll look at the remaining life of the HVAC unit, the remaining life of the roof, the remaining life of the electrical system, the siding, and they'll come in and they'll say HVAC system has a 2-year life, roof has a 3-year life, and then they allocate the purchase price accordingly. Then I can use bonus depreciation on a lot of it. And even if they take the bonus depreciation away, I can write it off over 2, 3, or 4 years. So always, talk to your accountant when you buy property, because that's when you do it, is when you buy the property. It's a short call. Get them the closing statements. Accountants like to really not give advice in the blind. You'd be surprised how many times I get a call. What did you spend? 30 minutes later, I still don't know what they spent on the building. So it's always good. Get the closing statement to the accountant so he sees what he or she sees what you got. And then they can tell you right away whether it pays to do a cost segregation study or not. But how many of you have done one before on a piece of property? Only 2 clients of my clients. Maybe that's a coincidental, I don't know, but you should.
You're saying an engineer does that, not an accountant?
No, the IRS requires an engineer sign off on it. Yeah. And I'd recommend a small engineering firm. The big engineering firms, they're big for a reason. They charge big dollars. Just get a local engineer. All I need is a signature of an engineer. In fact, some of them call me up and they kind of say, they don't quite say it this way, but they go, Chris, can you put this together for me and send it to me to review? And then lo and behold, I get almost exactly what I want. They always make a little change because they're afraid I'm going to tell the client that they didn't do anything. So they always tweak it a little bit, but on a big project, you really got to do it, Okay, so that's that. Now, back in March, there was what was called Secure Act 2.0. Do any of you remember that? It was signed back in March, and a very unusual thing happened. 100 senators voted in favor of it. It passed overwhelmingly in Congress from both sides. So it was like everybody at the party agreed to this. Now, sometimes that's scary because a lot of times that means there's hidden revenue enhancers built in it, that it's like, oh, this is great. The voters aren't going to figure it out. We get reelected and then we put the screws to them later. But actually, this wasn't a bad bill. It was passed in March. It truly had everybody's support. Maybe they wanted to get home for Easter. I'm not really sure. But I want to go over a few things in this. The biggest change, most of you know, the RMD, right? What did they do with the RMD? Used to be 70.5, now it's what? 72. Required minimum distribution for anybody retired. So when you turn 70.5, you have to take a minimum amount out of your IRAs, your 401ks. They changed that to 72. Now, let me tell you something about tax planning. When a client calls me up and they turn 70.5 and they have to take required minimum distributions and they're complaining to me because they don't want the money, you know what I tell them? Your tax planning was perfect. Your estate and tax planning is perfect because you put all this money away, you don't even need it, and that makes me happy. What I don't want to get is, Chris, I'm retired, I don't have enough money to live the rest of my life. And then it gets really dangerous. And that's usually one of the only times I recommend an annuity, because there's some good annuities that have guaranteed returns. They can't afford to take a loss on the market, like the loss we're having this year they'd have to move in. I don't want to say RV because I can't say it. They have to move in like a used trailer park, or something. I have to change that. But it's really scary when someone comes in and they just barely could have enough money to retire on. But when they have so much that they don't want to take required minimum distributions, that's really a good thing. Don't you agree? It's like, I don't want this money. I want it to go to my kids or whatever. Well, they changed it from 70.5 to 72. Okay, so I think that's a good thing. It delays the government getting the tax revenue on that. And you could say, why would the government do that? But hold on a minute. So this is not exactly law yet because they're still discussing it. Even though everybody in the Senate voted for it, the language wasn't clear. So they have to have committee meetings to clarify what they voted on, because they don't actually know what they voted on all the time. So they're still trying to clarify this. But one of the things they put in is that the required minimum distribution is going to continue to go up for 10 years. So that eventually in 2033, it'll be 75. So they're going to add like a few months each year. And they're going to actually get required minimum distribution to 75. Everything I see says that's going to happen starting in 23 when it goes to 73. But they're still trying to figure out the regulations and what your birth date is to see which one you qualify under. So they're still trying to work it out. So that's all good for people who have planned their retirement, have done really successful. You know, some of you do self-directed IRAs and you're putting big gains in it. And, you know, so it's all good. This is all good. Here's the danger on this. They always sneak something in. Right now, if you don't take your required minimum distribution, you forget. And people do. I mean, I have a client right now, I worked on his taxes yesterday. Now he's well off, okay, so don't feel too bad for him. But his RMD is $130,000. I got no 1099-R for last year. I called the person who manages it. They go, Chris, I don't see it coming out of the account. But I don't know, maybe he took it. I go, well, if it's not coming out of the account, he didn't take it. Can you see if there's a 1099-R? He's too embarrassed to call me back. He sends me an email. Because it doesn't look like he take it. No, he did not take it, right? Is what you're telling me. So what do? Well, the code says you double up now. So in 2022, he's got to take 21s and 22s. And then I have to make a decision whether I want to blow him into the IRS or not. If I blow him into the IRS, I ask for permission. My client was too busy, forgot to take it, and he doubled it up this year, and then they say, okay. But sometimes we don't want to ask for forgiveness, but that's when the amount is small. You know, if an elderly client forgets to take their $7,000 RMD, I just tell them, listen, just calm down. Let me call the person. He'll take 14 this year. In the case of this one, we definitely are going to basically turn him into the IRS and ask for forgiveness. And we'll get it because if you make it up in the next year, immediately upon discovering the problem, they like it and they'll sign out, especially when the market dropped, you know, and they still get their revenue. So what they changed it to now, what's going to happen is if you don't take it and you don't fix it, it's a 50% penalty. So he has to take 2 years this year, right? There's no question. If you forget to take it in the future, they're cutting the penalty in half to 25%. However, when you ask for forgiveness to fix it, 10% penalty. So in my client's case, where he's going to have to say, take 260,000, he would be subject starting in 23 to a $26,000 penalty that I can't get him out of. So that's what they snuck in there. So RMDs are important. Now, how do you make sure you take an RMD? You have all your retirement money. Everywhere where you have your retirement money, you sign a statement authorizing that place to cut the check automatically every year. You tell them whether you want it monthly, quarterly, once a year, But you, usually if you don't need the money, normally you take it in November because you want it to continue to grow in the IRA so you don't have to pay tax on it. You take it in November. Now, don't take it in December because historically, even in a good year, the market takes a beating in December. So I always tell clients, take it in November. Take the money out in November. If you need the money to live on, you're going to take it monthly or quarterly, but you sign and you direct the financial institution to do it. If you got your retirement money in 3 accounts, you have 3 of them sending you checks. The problem comes into play is when you got 3 IRAs, but you want to take it all out of company A because they don't do as well or something. So you don't want to touch B or C because they're doing well. So the obvious question I ask is why are you not closing A out and transferring it to B and C, right? I don't know. Some people like to have the pot and 3 kitties because maybe A will do better. I understand it. But when you want to take your distribution all out of one, there is no automatic because you have to calculate, which means you got to call your accountant. You give them what they need. It's an easy calculation. I do it while the client's on the phone typically, if I have everything. And I give it to you, then you have to contact them. So you don't get that automatic. That's the only problem. Now I'm a CPA. When and if I retire and I have to take my RMDs, I have the institutions do it automatically. I'm not going to do calculation for myself. First of all, I got no one to charge. So why would I do it? Let them do it. But I just think it's easier. So now, what else did they do in this bill? Inherited IRAs. In the old law, when you inherited an IRA, not a spouse, okay, non-spousal inherited IRAs. So you're getting it from dad, or you're getting it from mom, or you're getting it from your neighbor, I don't know. But you got an inherited IRA. The old law was you would segregate that in an inherited IRA account. You can't commingle it, okay? You keep it in a separate account, and then you would take it yearly in RMD, no matter how old you are. You could be 20 years old. You would start an RMD out of that for the rest of your life based on a table, okay? And you would get it. And my wife every year gets a $1,300 check from her mom's inherited IRA. She doesn't tell me about it. But the good thing is she usually uses it for my Christmas gift. So I can't complain, except I get the 1099-R and there's no withholding. And then I go to her in January and go, Beth, can't you tell them to do some withholding on this, you know? But, and you take it for the rest of your life. The new law, no. That's out the window. Now, you have to take the RMD over 10 years. So if you inherit $1 million IRA and you're 20 years old, you got 10 years to get all that money out. Now, the nice thing is you can time when you take it out. So you could take it out evenly. You could take it out in chunks when you want to take it out. If you can look at the horoscope and realize when you're going to be unemployed, you take it out the year you're unemployed. I'm not sure how that works, but you only have 10 years. The only exception to that is if you're a minor. If you're a minor, it doesn't start until you become a major, you know, but you got 10 years now. So that's not really good because what's happening is you're taking the money out in many cases. You're taking it out while you're still working. It's pushing you in a higher tax bracket. Maybe you just started collecting Social Security and you're working. And now your Social Security is taxed to 85% because your income's too high. So that's not a good thing. That's generating revenue. And that was kind of what they call revenue neutral. One's supposed to offset the other. So they're delaying the RMDs, but they're making the inherited RMDs get paid out in 10 years. Now, there's one exception to the 10-year rule that I must have gotten 30 telephone calls on. In the year that you get the IRA rollover, the year that you get it, the inherited IRA, So mom dies in July, you inherited her IRA, okay, from your mom. You have to find out if she took her RMD for the year that she died in. If she did, you have to take it by law. So you always have to find out when you get an inherited IRA, the year you get it, you got to call the broker, the bank, the financial person, find out, hey, did mom, did dad, did they take their RMD this year? Sometimes the answer is yes, sometimes the answer is no, sometimes it's partial if they're taking it monthly. They'll tell you what you have to take now out of that IRA in that year before the end of the year. And it causes a lot of confusion. Then you got your 10 years going forward. But you want to keep that in mind because that could be really, really damaging. You don't ever want to get into that. Yes.
Are you able to reinvest that money?
Yes.
Okay.
Oh, yeah, it's your money. We can't reinvest it in an IRA. You know, it's out, it's pulled out, so it's yours at that point. Now, what else is in this bill? There's a provision in it that says employers have to sign people up for 401ks. How many of you have or have worked somewhere where you had a 401k plan? Okay. Did you ever work anywhere where like the employer forgot to tell you? You found out later on you could have been in it? Yeah, unfortunately, it happens too often. I don't know if it's deliberate or they don't care. I'm not sure which it is, but the government is upset about that. And if they audit the company, the employer would say, well, you know, I talked to Kathy, she just didn't want it. And they'll go, well, did you have her sign off on it? Oh, yeah, just a minute. Hey, Kathy, can you sign this? And then they give it to the agent, right? So now the IRS is saying you must enroll new employees into a 401k plan. You got a 401k plan, you have to enroll them, whatever it is. If it requires 6 months of employment, on the end of that 6 months, you must put them in. And you have to put them in at no less than 3% and no more than 10%.
What about a simple IRA or something like that? Only a
No, I'm going to get back to that. No, 401k plans. You must enroll them. Yes, starting in 23.
That's for all employees.
Yes, all sizes. Now, it doesn't mean the person can elect out of it. The person, Kathy, in my example, Kathy can say, you can't take the 3%. I need the money. It's like, no problem, Kathy, sign this that you want to opt out. So you see what the government did? They're making the employee opt out instead of opting in. I'm actually okay with that because it doesn't really, if the employer is doing the right thing and letting people know they're eligible when they're eligible, then there's really, it doesn't hurt. Because you're going to go to Kathy and say, listen, you've been here 6 months. We love you, this and that. We have a 401k plan. Here's the paperwork. If you don't want it, you got to sign off. Because if you don't sign off, I'm taking 3% out or 5% or 10%, whatever. They're leaving it up to employer to decide to take 3 to 10%. I don't know why they're doing that. Just set a percent. Why you got to make it harder on employers, you know? But it's between 3 and 10. But keep in mind, it can be matched out. And it doesn't have to be a matching 401k. If you have if your employer has a 401k and they don't match, you're not forced to do a match. Treat it the way you would treat anybody else. Okay. But I think it'll clean it up. And then there's something called the Savers Credit, which nobody knows anything about this. This is like the world's mystery. No one knows about it. It's never promoted. And occasionally I get a client that gets it and I call the client up and I go, you're getting $1,000 back on the Savers Credit. They go, really? Oh, that's great. They don't even want to know what it is. It's just, I'm getting $1,000 back. This is great. Savers Credit is when you're single and your income is under $34,000, your adjusted gross income. or you're married filing joint, your income's under 68,000, and you put into an IRA or 401k plan, the government rewards you with a refundable tax credit. And that refundable tax credit, if you're single, is up to $1,000, and it's 2,000 if you're married filing joint. And here's the beauty. You don't have to put that much in to get the full credit. But here's the problem. When someone's making $35,000 and living alone, and I tell them that put into your IRA, they go, if they're young, they're going, I spend my money at Ferraris every Saturday. I can't not put money into an IRA. If they've been married and they got like a, I call a mother with a dependent child that makes 32,000. I go, if you put a couple thousand in your IRA and get your $1,000 back, yeah, okay. I mean, it's just not going to happen. They're barely surviving now, right? But it happens. To be honest, I see it with students all the time. Students will go in, they get a part-time job while they're in college, they do a 401k. I do it and they get the savers credit, Usually the only thing they want to know is mom going to get the money or can I get the money put in my checking? I go, I can direct deposit it right into your account. But it's there. Now, what's nice about it is they kept it in the law. It's in the law. They didn't change it. They didn't make it better, but everybody kind of thought it was going to go away. But jumping forward to the new law that was just signed where they're going to hire $87,000 IRS agents because they're concerned about you. In that bill, they are directing that the IRS start a campaign promoting the savers credit. They're actually telling the IRS, use some of the money that we gave to you to waste to actually inform taxpayers about the savers credit. So you're probably going to start seeing advertising. You're going to go, wow, is this new? No, it's not new, but the IRS is being told they have to promote it. So I'm not sure what promoting means, but this is all in the truly bipartisan. Bipartisan means both parties voted for it, right? So they'll try to tell you that this new tax bill was passed bipartisan because one Republican congresswoman voted for it. That's not bipartisan. This was bipartisan. I mean, 100 senators and 100 senators voted for it. You don't really see it. Just don't see that often, but it's a pretty cool thing. So now let's jump ahead, and I do have a handout on the Inflation Reduction Act of 2027. Can we hand these out? This must be the extra one that she told me she stuck in. So I wanted to give you a handout. Now I have to tell you something. It's 300 pages. So you're getting 4 pages. The actual bill is 300 pages. It's not readable. You can't read it and understand it. They scratched this bill out and they got it passed and no one knows what they voted for. The Democrats were told to vote for it by Schumer and what's the woman from San Francisco? Yeah, I don't say her name. They basically said, you vote for this or you're not getting funding for your reelection. Okay. Then is it Mitchell and what's the Republican House person? McConnell's the Senate. They basically went to Republicans and said, you vote for this, you're not going to get funding. This was not nonpartisan. There's 50 Democratic senators, there's 50 Republican senators, and Vice President Harris was a Democrat as the tiebreaker. It passed 51-50. So this is not a nonpartisan bill. This was all about partisan. And that's how it passed, 51-50. And it passed along Republican Democratic lines in the House, except one Democrat voted against and one Republican voted in favor of it. two out of what? 400? I don't know how many there are. Is it 437? Is that, I was gonna say 438. It's 437. Okay, 437. So there were two people that didn't vote along party lines. And coincidentally, neither one of them is running for reelection. So they just didn't care. So this bill is an interesting bill. First of all, the bill is called Inflation Reduction Act of 2022. I believe any bill ever passed in the history of the United States government, this bill will cause the largest amount of inflation we've ever seen in our life. I don't know where they got the name from. I mean, they like cute names and they wanted you to think that they actually were doing something about inflation. It has nothing to do with inflation. There's nothing in the bill about inflation. Everything in the bill is designed to extract more money out of you. Okay. Now, the first thing you all hear is say, oh no, we're going to raise taxes only on the big corporations. Okay. We're going to go after Procter and Gamble. We're going to go after Exxon Mobil. You know, we're going to go after IBM. We're going to go after Apple Computer. It's not going to affect you at all. Now, you believe that? Because what does Apple Computer do when their labor rate goes up 10%? Okay, they charge more for this phone. Okay, do you think they would do something different when taxes go up? Do you say, oh, no. All the executives have to take a cut in pay. All the executives and no raises for anybody because we got to pay a 15% tax. No, they're going to say we need to increase costs. Put it in the budget. We got to pass it on. And I mean, it is actually feeding inflation. It's actually fuel for the fire. And they call it look at the top. It's unbelievable. Inflation Reduction Act. Okay, this 15% tax is going to drive everything up. It's huge. Because I've always said this to people. I don't care whether you're in favor of small business or big business. Taxes are all paid by individuals. Businesses don't pay tax. Businesses are a pass-through. They pass the money to the government, then they increase the cost of their product, and they get you to pay for it. All taxes are paid by individuals. Okay, I'll get people to say, well, I'm in a zero tax bracket. I go, really? Did you buy anything that had sales tax attached to it? I mean, you know, everything gets passed on. So I don't know, but they say it with a straight face. They really do say it with a straight face. Like this is going to help you, you know, because how many times have they said, we're not going to increase taxes on anyone that makes over 400,000. Well, if you buy gas, you're contributing, you're paying the 15% tax. If you're buying clothing, you're paying the 15% tax. If you're buying any service, you're paying the 15% tax. So I don't know, but this is also coming from someone that talks to the dead when he does an interview. Remember, where's Jackie? Jackie, she must be in this room. Just spoke at the funeral 6 weeks ago. He's looking for Jackie. So I don't know what to tell you. I think he actually believes that this is a reduction, but I'm not sure where it's coming from. So be prepared. This 8.7% COLA is not going to handle it. Okay. We haven't seen anything yet with inflation. In fact, it was leaked today that Biden told the Saudis not to reduce any further the oil output till after the midterm elections. And that was leaked out today. You won't find that on CNN, but you'll find it on, I think you'll even see it on USA Today, which is pretty weird because they usually go along with CNN. But I was telling Scott, fill your RV up before the midterm elections because they think gas is going to shoot up a lot. Like I'd look at getting a spare 100-gallon tank to stick in there, just to be sure, because I don't want to find out you can't come back to do your taxes because you can't afford the gas to come back. So you know about that, right? 15% tax on corporations, and it won't affect anybody making under 400,000 because they promised you that it would not affect you at all. In addition to that, they budgeted 87,000 new agents. So sometimes people don't know what that means. In 2020, which is the last published data from the IRS, they had 75,775 employees. So the IRS had 70, let's call it 76. They had 76,000 employees. They're adding 87. Over 10 years. Think about that. They're doubling it. They're double. Nutrition? I don't know. You can hope for that. The budget is $80 billion over 10 years. $80 billion over 10 years. And they are directed to increase audits and collections because they believe they can pay for this bill by auditing clients, generating the refunds off of the cheats. Now, they make you think they're only auditing big business. Do you realize big business is 100% audited? Kodak had a whole wing with IRS agents and New York State agents. A whole wing, they had permanent offices. There was a guy that taught at night at MCC. For 20 years, all he did, he worked for the IRS. All he did was audit Kodak. And he would go to work at Kodak, not the IRS building, at Kodak. Big businesses are always under audit. So don't think for a minute Caterpillar is not getting audited, Apple's not getting audited, ExxonMobil, they're all being audited. Just look at their financial statements in the tax section. They'll talk about 15 years still under audit. Well, people were shocked at that when Trump said, when the audit stops, I'll release my tax returns. And he had like 12 years, he said that we're under audit. People couldn't believe it. That's how big business is. They're always audited. So who is 87,000 people going to audit? I'm just asking the question. Who are they going to audit? They're already auditing big business. You know, so it's kind of a fascinating thing, but they really believe they're going to get it. Now, besides the $80 billion, the IRS also got a 13% increase in their budget. Besides the $80 billion doesn't count. They got a 13% increase in their budget. So they got a 13% increase plus the 80 billion. I guess there's a difference in there. I don't know. I don't know why they didn't put it all together. But, and I don't know the budget to tell you exactly what it is. So what else is in this thing? I gave you a document that you can read through. The other thing that I get a lot of calls on is a whole green initiative. The green initiative. So let's just talk about it. There are credits for individuals for relying, if you can convert to something that's a renewable resource. So even though the Colorado River has no water left in it when it goes to Mexico, that's still defined as a renewable resource. Okay, because they're just defining water as a renewable resource. Water, geothermal, I guess batteries are, which I don't quite get because that depends where the electricity is made, but they're saying that's renewable. What am I leaving? I'm leaving something else out. Solar, wind, right? Yeah. So those are all renewable sources. So there's a lot of credits around there. One of them is, do you remember the old residence energy credit? You could only get $1,200 in your life. That's all you're allowed. That goes all the way under Bush Senior. That's how old that is. And you get an energy credit of $1,200 lifetime on that particular residence, the house you're living in. So you do windows, you do insulation, whatever, but one HVAC, but once you use the 1,200, that property's done as long as you own it. Buy a new property, you get the 1,200 all over. They changed that to 1,200 per year on the same house. So that's big. You do the windows 1 year, you get a $1,200 credit. You do insulation another year, you get a $1,200 credit. So there's passive things to save energy. You get a credit, and it's 1,200 per year, starting starting now, and that goes through 2032. Your residence. I'm only talking about your residence right now, that you get $1,200 credit. So it's doors, windows, HVAC, things like that. Okay, so if your windows are too expensive, maybe you do the front 1 year, you do the back the other year. I don't know. If you want to maximize the $1,200 credit, it's up to you. You know, you got to work it out. I don't know if I would pay a premium to do it, but it's good that they do it because I'm sure energy costs are going to go up. Now, they also had made changes with vehicles, good and bad in this. Used to be, if you bought a qualifying vehicle, you would get a credit in the year you bought it. It was a nice credit, but it had to be an eligible vehicle. So it had to be battery or plug-in, electric, hybrid, and it had to be an eligible vehicle because they would make so many, and then after that, that model would not be eligible. Some companies like Toyota played that really well. There's like 50 models of Priuses. So every time they hit that, they came out with a new Prius model. They made some change to it. Other companies like Ford and Chevy and Tesla didn't really play that game the way Toyota did. So they had like yeah, they would run out, then you don't get it, you know? But Toyota played it really well. They were always coming out with new models. I don't know why other companies didn't jump into that. But anyways, they changed that now. They're going to get rid of that. So it doesn't matter how many vehicles they sell. Okay, it won't matter anymore. You don't have to, if it qualifies because it's electric or a plug-in hybrid, you're good to go. Okay. Now, I don't know this because personally, I will never buy an electric car. And I have a car fetish. I actually have 7 cars with license plates on them. So I get up in the morning and decide what I want to drive. Today, I drove my new Bronco.
Are they all personalized?
Huh?
Are they all personalized license plates?
No, because to personalize them means I have to send this state corrupt government extra money. That is never going to happen. Chris Sardone is never going to send New York State extra money. Not happening. Never happen. But I do have a bit of a car fetish, but I don't have a fetish for an electric vehicle. First of all, they can't answer one basic question. If I go 3 months at a time without using a car, what's going to happen to the life of this lithium battery? And they look at you like, not a clue. Because, you know, when you don't use batteries tend to die, right? I don't know, because I have cars that I don't use for different seasons, you know? And I'm crazy. I have an F-150 Ford pickup, which, by the way, of all my cars, that's the one I love the best. I put a cowboy hat on when I'm in it. And I don't use it in the winter because I don't do real estate work in the winter because I'm an accountant. So I use it outside of tax season. So it's never been used in the winter, and it's a 2007. And it's probably my favorite little toy. And it's cool because it's got roll-up windows. Any of you ever see those F-150? Yeah, I do have a radio in it, power steering, power brakes, and air conditioning. But the windows are roll-up. It's great when you get a kid in the car. I go, open the window. Mr. Sardone, I don't know how to open the window. But I love it. I actually love my truck. But I can tell you, never in my fleet am I going to have an electric car. Having said that, I do have $100 deposit on the Tesla pickup truck that 3 years ago, I don't think he's ever gonna make it. I did it just for fun. And maybe I'll sell the contract to one of you if you want a Tesla pickup truck and sell you my spot. So I say never, but I don't know. I don't think ever. I don't think it's ever gonna happen. So they changed now so they can make unlimited number of cars. That's a good thing. Because I had a client that had a Prius on order. He called me up. He goes, no, it was a Nissan. What's the Nissan? Leaf. Had a Leaf on order. It finally came in and they don't have they already exceeded. He doesn't, even though he ordered it a year ago, he's not eligible for the credit. So I said to him, I go, don't take delivery to next year. I go, why? Because it won't matter next year. I go, tell him you don't want it, order a new one, get it next year. And you'll get the credit because next year you don't lose it. So you have to kind of plan that a little bit. But here's the catch. It has to be final assembly in North America. So that means it's got to be assembled, just so you know, definition of North America. Canada, United States, and Mexico. It has to be assembled in Canada. Yeah, I think it's great because when a car is assembled in Mexico or Canada, it still has major components made in the United States. So I think it's good. No. No, I think it has to be a final assembly in North America, Canada, or Mexico. And the credit could be as high as $7,500.
Oh.
Depends on the vehicle. Yeah. And then they're also going to allow it, they're going to make a used market. You can get up to $4,000 on a used electric or plug-in hybrid. So that's new. Because these used ones have been dogs on the market. The property, the value of them drops. There's no credit. And people are picking up like Volts for $2,500 that are like 7 years old. So they're creating a used market now by doing this, which I think is good because we're trying to go green. Do we really want battery cars in a junkyard after 10 years? We really want them out there. And if the car's near the end of the life on the battery and it's 10 grand to get a new battery and the government's chipping in 4,000 and you're getting a good deal, it might make sense to keep the car on the road. But again, it's thank you to everybody that pays taxes because it's a credit. You know, we think when the government gives money, like that's our money, right? You realize that. They're buying votes with our money. And then we applaud it. Like, oh my God, this is really nice. I mean, you're going to redirect my money to a credit? Oh, you mean you're going to do student loan forgiveness? I didn't go to school. I went to tech school down in Florida, and I can repair a car really well. And I'm really excited about paying off someone else's school loan. You know, this makes me feel like an American, you know, but they talk like they're reaching into their pocket with the money. I'm going to forgive your student loan. Huh? But you know, there's a lot of court cases going on all over the country about the student loan thing. So Biden secretly, under the cover of nightness, modified the forgiveness a little bit. I don't know if you're aware of that. I'm sure if you have a student loan, you're aware of it. In May, 750,000 people was estimated ineligible without any promotion or any advertisement or anything, just quietly. So I think he knows he's got a little bit of a problem with this loan forgiveness. My prediction is going to be reduced to $5,000. That's my guess. Now, why am I guessing that? Because I kind of read what some of the politicians are saying. You know, we get these bulletins, and it seems like they might end up cutting in half to 5,000. I don't think it'll go away. The problem did I do something? Okay, I better shut up. Okay, I got it. You're very nice about it. You're such a gentleman. He just told me to shut up quick. But we'll do it. We'll do it. The SALT deduction, the lost SALT deduction, you're limited to $10,000 for taxes. That stayed in the bill. Now, what's interesting, there were probably 100 Republican congressmen and probably half the senators, Republican senators, that would have voted for this if they had restored the SALT deduction. They didn't do it. And it got real, if you remember, it got really iffy. Nancy was counting, I said I wouldn't say her name, but she was counting the votes to make sure she had enough because they did not want to do the SALT deduction. They did not want to bring it back. Even though McConnell ran a campaign for Biden, crucifying Trump for the SALT deduction, saying it has to go, it's not fair, it's not fair. He forgot after the Democrats took office. And he himself would not allow it in the bill. So he lied. I mean, really lied. That's an outright, straight, raw lie on the SALT deduction. But here, the good news is it expires in 2025. So it's not permanent. It expires in 2025. It'll go away and go back to the way it was, unless someone votes in favor of it. Now, the problem, well, all right, I got to stop. I'm done. I did the handout. Questions. Let's see if I can answer any questions. Now, I have cards. I have cards up front that you can grab. Because I believe this handout has my email. I think Karina, my office manager, at the last minute put it up on the top of the, yeah, she wasn't very pleased. She said, you couldn't have told me this before I copied them. I go, I can't help the fact that you're so efficient and copied them so quickly. So she made, I think, labels. Are they labels? Yeah. So email me with questions if I can't answer them, but questions.
Mark, when should we think about getting involved in that gas turbine?
You're talking about the PTT thing? Well, first of all, you got to be eligible for it. So you have to have a sub-S corporation or be in a partnership. But you should do it. There's no reason not to do it because you get the deduction. What happens, what he's talking about is if you have a partnership or a sub-S corporation, you send New York State money for your New York State taxes. And you can deduct it in the partnership or the sub-S corporation. And then you get credit like withholding when you file your tax return. It's a good program, but New York made it a little complicated. I don't know if you've been through it with your accountant. They just made it complicated, but it makes sense. We did it a lot. Yeah, but you can only do it on the profit of the partnership or the sub-S. So let's say your sub-S makes $10,000. So the federal, you can only do it based on that profit. So if you pay 20,000 in, you don't get a $20,000 reduction. You get like a 2,000, you got to wait to get the other 18 back. There's a refund. So it's based on the profit of that entity. So just don't run out the form of sub-S so you can prepay your state tax and get a deduction for it. It's got to have a profit in it. But if you're eligible for it, you should do it. It's not a big deal. It's really not a big deal. Now that we've been through it for a year, accountants are much more comfortable with it. That's a workaround, the SALT deduction. But it's a workaround only for profitable partnerships and subchapter S corporations. Why? I don't know. Well, we usually walk the clients through them. Yeah, I don't know too many people that are using an attorney to do it. I don't think attorneys would know how to do it. Some might, but accountants know how to do it.
Is S corps only or LLCs if it's a partnership?
I'm sorry, what?
S corps only or LLCs if it's a partnership?
Partnerships, an LLC that files a partnership or files a sub S is eligible. Yeah. Yes, absolutely. Because an LLC, you can elect either one. Because there's no LLC filing. So you have to, when you have an LLC, if it's single member, no. That's not eligible. So it needs to, unless it's a corporate, you're filing a corporate return.
I'm just curious about the 401k mandate to opt out instead of opt in. What does the government have to gain by asking for?
Because they want people in the plans.
But there's the taxes deferred, so usually.
Oh, yeah, but they want to get pressure off of Social Security. They don't want to be giving senior citizens food stamps. They want them to have money.
So they're playing the long game.
Oh, absolutely. Absolutely. Now, one thing I didn't mention, I have to mention, New York State, our governor, because it's re-election time, got a bill passed that says every business in New York State has to have a pension plan. They don't have to match, but they have to have a plan. Now, you know how she got it to be passed, how the Democratic legislation passed it? No starting date. They're going to talk about that after November. So we have a law in the books that says employers must have a plan. They don't have to do a match, but they have to offer a plan. So the way I read the law, they can just offer simple SEPs, right? Or SEPs. It's like, go to the employer. You want to put money in, put it in. You don't, you don't. But they got to offer it. So it's just more work for the employer. But there's no start. Did you ever hear a law that has no starting date? They passed the law, but now they got to pass the starting date. So I don't think we're going to see it in 23. We'll have to wait and see. It's a big burden on small employers. Big burden. Now, that's interesting because you talked about the long game. So I have to offer you a plan. So I offer you a plan, right? And you put $100 in. If your income's high enough, you can't do an IRA now, can you? Really? So there, it's a short game.
Oh, yeah, I'm just thinking that this 40 years.
Concludes you, right?
Participating in our 401k, breaking it out of match as a part of your personal savings.
You did the right thing.
I used to have to push it to get as high as 87% participation rate. And now they're saying it's mandatory, basically.
Unless they sign off. But in New York State, they're going to require it. But there's no starting date for that. So it's kind of ridiculous to talk about. I've never seen a bill like that passed. But I think it was designed to say, okay, we're not going to really do it, but we want stupid people to get excited about it and vote. I'm just telling you the truth. I think that's what it was all about. And then after the midterm election, the legislation will say, no, we're just kidding. We're not going to require employers to do it. Question?
So let's see. There's a couple questions online. What is a SALT deduction? So he doesn't know about
Oh,
the property tax.
okay. SALT deduction is your state taxes and your real estate taxes that are an itemized deduction. That's now limited to $10,000 is an itemized deduction. So we call it a SALT deduction limitation. Before, if you had property taxes of $16,000 and $8,000 in New York State income tax, you had a $24,000 deduction. Now it's limited to 10. Good question. I forget, anybody remember what SALT stands for?
State
and local tax.
And okay, so there was another one on the back to the IRAs. Does the change to take the minimum deductions, minimum distributions on an inherited IRA impact IRAs that were inherited before 2022?
No, very good question. Who asked that question?
That was Kelly Lane.
Kelly, excellent question, and I should have said that. It's the year, it goes by the year of death. So once you inherit it, if you're under the old program, you're grandfathered under the old program. Rest assured. Goes by date of death. So it started with deaths after March 22. I don't know the exact date in March. I could look it up, but there's an exact starting date. That's two great questions here.
And I think that's
Okay. And email me if you have questions. I'm pretty good about it. Just give me a couple days.
It's March of 22 on that. What's
For what?
For the inheritance?
I think it is.
Okay.
Yeah. Yeah. So if you inherited in July, you got 10 years to get the money out. You inherited it in January,
There's November.
you have your life to take the money out.
Mm.
Hi, Jack. Your mic's not muted again.
Because if you live less than 10 years, then I guess you're trouble either way.
I have a question. If you have an inheritable IRA to a child that has a disability, can you put that into a trust?
You know, there's always a question like that. Can you email that to me so I get you the answer?
I certainly will.
I got to look into that one. I don't think the trust helps, but there may be a special rule for disability. Shoot me an email on that. I will get you an answer to that because now I'm intrigued by the answer to that question. So
Thank
I'll
you.
check.
I think that's pretty much it.
I thank you all.
Thank you.
I'm
Can
sorry.
you put the email online, please?
Oh, yeah. Are you going to put the handout?
John Cherry says corrections value of the real estate. I don't know what that means because it's not English. Can we have a full sentence, please, John?
No, here is, you got to put this up online, right?
I have a self-directed IRA. The RMD
Yeah, I got, I'm good with this.
Real estate and who determines that value? Who determines the value on a self-directed IRA with real estate in it?
So there should be a third-party trustee.
Okay, there you go.
So they're going to do it and they have to give you the value on January 1st of every year.
Third-party trustee.
I'm going to give, you're going to put this in, right, for the people
So
online?
you email me those, they'll be on the website.
Oh, I'll email them to you. Okay,
And then.
Okay.
Vendor listings.
Thank you.
okay.
So click the link, look at all the vendors who spoke tonight. Chris is one of our vendors. Get his email from there.
Okay, I'll get that. So I just email it to you. Okay, super.
Me, Leon, Joe, whoever.
Okay. Okay. Thank you. And I found a new restaurant to go to.
Okay, great.
This is a pretty neat place.
So,
Chris-
What if late at night I can get.
Hold on, nobody can hear you.
Oh, this has to come off.
Well, I mean.
yes.
Talk anymore.
So, thanks to Chris for
Nice.
an excellent presentation. We're gonna have pizza and things outside like we did last time. So hope to do some more networking with everyone out there. So thank you very much and look forward to seeing you in November or at one of the subgroup meetings where all the action really takes place. So thanks again. Any folks got any questions I can answer or anything? All right, we're good to go. Thank you
All
very
right,
much.
everybody on
Thanks, stay
Zoom.
on the line.
The next meeting is next Thursday, 7 p.m. on Zoom. It is Joe LaBarbera and Scott Spear running the Aries group, which is where you can go and sell properties and buy properties and all that other fun stuff. So I'm going to end the Zoom meeting. Thank you all for coming.
Thank you.
Appreciate it. And we'll see you next time.